only and only, chapter 2, only investments in equity. And through the entire course, we're going to talk only about investments in equity. So now let's see how many types of investments we have. We already know the few of them. And again, back to intermediate financial reporting 1. And there in chapter 10, it was your first meeting with the investments in equity, because that's one investment is part of the current assets, and one of the assets, one of the investment is investment in equity. I mean, there's no other investments. The investment is only in equity. The other option is to you to become a creditor, but then you you're buying a liability in that case. So the big picture is equity investments are investment in the shares of another company. Now you have two options: either company to be publicly traded, either company to be private. There are many different methods to report investments, and those have significantly changed over the past 15 years. They're now trend to measure more assets and fair value. So as you can see, all the accounting moving to the fair value, not on the day of the transaction for the reporting purposes. Prior to 2005, the investments were typically reported at the cost-based amount. Then International Accounting Standard 39 came, introduced 2005, that the first time possible to certain investments to be reported at the fair value. And then another explanation of the changes of the standards and how the standards move on. Now, in 2011, International Financial Reporting Standards 13 came, where they're talking about the fair value measurement. And then we're going to have different investments. Investments, it can be non-strategic investment or can be strategic investment. So based on what investments are, that's going to trigger which method we to use. So don't forget, recording is the day the transaction happened. Reporting is the day when we report something because of the year end. Some event happened. Year end, quarter end, half year end, anything like that. So we're going to have two types of investments. First one is the strategic investment and non-strategic investment. Strategic investment. Inside, we're going to have three different investments. First one is significant influence. Second one is control. The third one is the joint control. What are the reporting methods here? Significant influence, we're using the equity method. Under equity method, there is no unrealized gain and losses. Next strategic investment is control. For control, we use consolidation. We're going to see chapter 3, 4, 5, 6, 7. What's that? 8 and 9. And then for the reporting unrealized gain and losses, there's no such thing. Joint control, we're going to see on chapter 10, I believe. No, chapter 9, I believe. We're using the equity method. And there's no such a unrecognized gain and losses. Now, on the non-strategic investments, that's where we're using the fair value method for the reporting purposes, not for the recording, for the reporting purposes, people. And we're going to have two types of non-strategic investments. First one is fair value through profit and loss. Second investment is fair value through other comprehensive income. Now, both are under reporting under fair value method. Now, where the unrealized gain and losses came, first, yes, they exist in those ones, since we're using the fair value. And the first one on the fair value through profit and loss, obviously net income is the place that we're going to show the unrealized gain and losses. Where in the second one, everything is going to go to the other comprehensive income. Now let's go with those two non-strategic investments. Fair value to profit and loss and fair value to other comprehensive income. Let's go first with the fair value profit and loss. Those ones including investments which are held for the short term. So if you're holding something for the short term, one of the options that you have is fair value to profit and loss. Once you choose that one, on the day when you buying it, you reclassify it as a current assets. Since those are actively traded on the active market and can be sold within 1 year. Again, recorded at the fair value. Fair value means the value that you paid. Unrealized gain and losses on the reporting date. Losses as well as a dividend received on receivable are reported on the net income. Now, the second one is fair value to our comprehensive income. Now, this is again equity investment, which are not held for the short term. That's the difference. Now, the first one was for the short-term investments, fair value to profit and loss. If it's for the long, not for short-term, then you have option fair value to other comprehensive income. Classify as a current or non-current assets. Who's going to tell us this? Management. You're going to check with the management. You're going to ask the management for how long you intend to hold the asset. If the management tells you it's a long-term assets, show it as a long-term investment. If it's short-term assets, show it as a short-term investment. Now, unrealized gain and losses, those will be recorded directly to the other comprehensive income. So they're not going to affect the current earnings of the company. But the dividend, if we receive the dividend on those shares, those are going to be recorded as an income. Now, the cumulative gain and losses, which are created out of those accumulated other comprehensive income, will transfer directly to the retained earnings. This usually happens when the investment is sold. So at some point, if you don't have the investment anymore, since you don't need it, it's you just to the time being you have it. Once the investment is gone, if there are any balance in the other comprehensive income, those has to be transferred to the retained earnings. Let's see now what's the cost method of reporting the equity. Those are how we're gonna measure those investments first. On the day of we purchase it. Now let's see for the reporting purposes. First, we're gonna use the cost method. Cost method is used on the International Financial Reporting Standards. On which cases? First, for the investments is control entities. We're going to see chapter 3. Or for the parent company or internal accounting records prior to preparation of consolidated statements. We're going to see that in chapter 5. Cost method is allowed under accounting standards for the private enterprises for equity investments that are not quoted on the active market as well. That's for the cost method. Under the cost method, investment is initially recorded at cost. Investor shares of dividend are reported in the income. Impairment losses are reported in the net income. When the investment is sold, realized gain and losses are reported in the net income. That's with the cost method. Now let's see what the equity method. The other option is the equity method for the reporting investment. Equity method applies for the investment in associate where the investee has ability to exercise significant influence. Now, which are the indicators of significant influence? Representation in the board of directors or participation in policy making process or decision about the dividend and the distribution of the dividend. So if you have your hands on the ability to report dividend or distribution of the retained earnings, you have significant influence. Material transaction between the investor and investee. So if there's a material transaction between one company and another company, material means, again, your judgment here. What is the material? What's not material? If that exists, there are significant influence. Interchange of the management personnel. So the question is in this case, is Tesla has significant influence in the US government? Why? Because the management personnel from Tesla also working for the US government. Now that will be questionable, right? Because US government is not corporation. In this case, we cannot talk about significant influence. Provisions of the essential technical information. That will be another evidence of significant influence. Now, the general rule is if the company holds between 20 and 50% of the voting shares, that's represent indicator that the company has significant influence over the other company. However, that might not be enough. Determination of significant influence, again, is going to require your judgment. What the general rules are, those are general rules, but you're the one who has to do the test. So that CPA is going to test you. So first, check, is that 20 to 50%? If you're close to 20, but not reaching 20, then check all the indicators. Because there might be something that can lead you to have a significant influence, even if you don't have 20%. Sometimes when you have 22%, again, check all the other indicators, because that might be indicators that you don't have. Determination of significant influence require judgment, your judgment, and when one investor has control. So let's imagine this. You're purchasing 20% of the shares of my company. I have a company, you're purchasing 25% of the share of my company. Seems like you have a significant influence, but there's a third party which already purchased 55% of my company. Now with the 55%, that third party company have already control over my company. So in that case, you coming second with 25. Now you cannot have significant influence. Why? Because the other people have control. I don't own my company anyway. You cannot have significant influence over me since the third party already have control over me. Make sense? So when the investor has less than 20% of the voting shares, usually they don't have significant influence. Income is recognized based on the income reported by the associate. So what's going to happen when we're using the equity method? Income is recognized based on the income reported by the associate, and the dividend are reported as a reduction of the investment account. Equity method, pick up the investor shares in the changes of the associate shareholders' equity. Now, there can be complexities with the equity method. First one is the investor statement of the comprehensive should be reflect the shares of the investee income according to the nature of different statement classification, and the investor shares of the income from continuing operation discontinued, they are comprehensive income reported. Those has to be reported separately. Now, what's going to happen if you have acquisition cost greater than the carrying amount? If the investor cost is usually more than the shares net says investor cost usually greater than the shares of the carrying amount. What's going to happen if we have unrealized intercompany profits? Then consolidated statement should reflect only the result of the transaction within the outsiders. And the profit from the intercompany transaction must be eliminated. This is one of the multiple choice questions that I saw on the CFE exam. No, not the CFE, Core 1 exam. There are two companies, one having significant influence, and they have intercompany transactions, which one company is selling inventory to another company, but that inventory hasn't been sold on the 100%. So the company, the other company, that company has significant influence, holding, let's say, 40% of the inventory. Then you have to eliminate that one when it comes to the distribution of the income. Changes to and from the equity method. Can we change from the equity method? Yes, we can. When the significant influence disappears, then you have to move to the cost method. Can we have a loss? So in order to explain this, let's go to the Excel spreadsheet and go over these things, because those are interesting things and I want you to see the implication. Just give me a second to prepare one Excel spreadsheet and we can start from there. Just give me a second and I'll be right with you. All right, ready to share my screen? So,
Yeah.
let's say we report the investment under the cost method. And here we're reporting the investment under equity method. So the first beginning balance is 0 here, beginning balance 0 here. Make sense? Let's, I'm gonna get rid of those two. Okay, like this. Can you guys see my screen?
Yes.
Yes.
So let's go with the first transaction. First transaction that's gonna happen, that will be the purchase of the investment. So let's go, debit, obviously we're gonna be investment. And credit is gonna be cash. Let's purchase something for how much? 10,000? Is it okay? Let's go with 10,000. Let's make those two like number modes. And we're good with this. Now we have our investment. We purchase investment for $10,000. And we're good. We're happy investors now. Right? Let me move those one here because I want to use more lines here and this one here. Get rid of this. $10,000. This is under cost method. Under the equity method, it's going to be exactly the same. Nothing more, nothing less. Exactly the same. And we're going to have here 10,000 purchase. And we have our transaction. That's number one here. So number two. Number two is, let's pretend the company declared dividend. Company pay and declare dividend. And let's say the dividend is, but we have to put some numbers here. Let's pretend that we purchase 2,000 shares. 2,000 shares, that will be $5, right? $5 per share. That's going to give us 10,000. Make sense? Are you guys with me?
Yeah.
So same thing here. We purchased 2,000 shares for $5 per shares, but those 2,000 shares, they present 30% of the shares of the company. Here they present only 1% of the total outstanding shares of the company. So we have no significant influence here. Here we have significant influence.
Mm-hmm.
So next thing, the company pays dividend. So for the dividend, the one that we use in the cost method, we're going to have debit, cash. Let's say they paying, the dividend is $5 per share. No,
No.
too much, $2 per share. $5 per share, that's too much, right? $2 per share. And so the company is going to get cash that will be equal to $2 times 10,000 shares. No, 2,000 shares.
2,000, yeah.
2 times 2,000 shares. It's going to be $4,000, right?
Mm-hmm.
And then the credit here is going to go to dividend income. The same amount, 4,000. Now, same scenario on the other side. We're still going to have the dividend. I'm going to copy it. But there will be some changes here. First, the dividend. Now, the company declare total of $50,000 dividend. That's how much company declare. So the question is, how much cash, how much dividend we gonna get? Since we own only 30% of the shares, we're gonna get, of the total dividend, we're gonna get 30%. Make sense?
Okay.
So in this case, we're gonna get 50,000 times 0.3. We're gonna get 15,000 dividend. Where we're gonna be, when we're gonna get 4,000? If we get 12,000, are we gonna get 4,000, 3,600? So we need 16. If I get 16, how much is gonna be? 4,800. So how much will be the one that is gonna give me exactly 4,000? No, 4,200 13,000. If I get 13,000, 3,900. So I have to get 13,000 and
No.
3,000 and 300.
Mm.
33. Oh, it's gonna be a very funny amount. So only 3,500, 13,500. Let's get closer. So the total dividend that they declare is what was that? $13,500. 13,500. Let's make it almost the same. So what's going to happen in this case? They get cash $4,050. Where the credit's going to go? What do you think?
Is it equity?
It's under equity method. So where the cash credit is going to go? Directly to the investment account. So the dividend here is going to reduce our investment. 40, or let's make it equal to this amount. So where's our balance here? Our balance will be equal to beginning plus purchase minus credit is going to be that much. Here the balance will going to be same, right? So you see in the equity method, as soon as we receive dividend, our investment is going to go down. When in the cost method, there's no effect on our investment. Make sense? Okay, let's keep going. Number 3, the third event that's going to happen is reporting period. Reporting. And the reporting here is December 31st, 2024. So in this case, let's say the fair market value of the share become $6. Okay, so what we're going to have? Under the cost method, I have to adjust my investment for the change in the fair market value.
Increase.
All right, so I have to increase it. So I have to do debit investment, and that increase will be $1, correct? And it's going to be 2,000 times $1 increase, or 6 minus 5, right? In the bracket 6 minus 5, and I get my increase in the dividend. So now where the credit is going to go?
No, this is investment.
It's not going to be investment. Where it's going to go?
No,
Going to be
no.
so it's going to go what the slide says.
Okay.
So let's go back to slides and check the slides, what the slide says in this case. Let me share my screen here with the slides. So the slide says that on the reporting date, the fair value is going to go to the
Net income.
ASA unrealized gain and losses. Make sense? So now let's go and do our journal entry. So the credit is going to go to unrealized gain. Why is unrealized? Because we're still holding the assets. We're still holding the investment. Unrealized gain of, let's say, same amount, 2,000. And what we have to do here, we have to increase the value of the investment with 2,000. And now ending balance is going to be, we have to add one more, plus here is going to be this one. So under the cost method, my balance went to 12,000. Now let's see what's going to happen on the reporting date under the equity method. Reporting date, fair market value is 6. what do I have to debit here? Nothing. I don't have to do anything. Why? Because my investment is already at the fair value. I don't have to do anything here. Make
Yeah.
sense?
Mm-hmm.
My investment is already at the fair value. In this case, on the equity method, nothing. Now let's fourth event. Fourth event is the company that we invested. The company report net income of $50,000. So in this case, under the cost method, so the company that invested by bought the shares, the company reported net income of $50,000. What will be my journal entry? In this case, debit not applicable and credit not applicable. No journal entries here. How about on the other side, on the equity method? Well, on the equity method says, since I have significant influence in this company, whatever they declare as an income, that percentage belongs to me. Make sense? So in this case, once the company report income of $50,000, that's going to increase my investment with amount of 50,000 times 30%. Make sense?
Sí. Yeah.
So now my investment is going to go up with 15,000. And credit will be to investment income now for the same amount. So here I'm going to have purchase again. And here that will be the net income of only 30% of the company that declaring that net income. So let's go here and grab investment, 15,000 going up. So how much will be my balance here? Will be 20,950. So what we have to see, what I want, what's the objective here? First, I want you to see that on the purchase date, there's no differences. Under the purchase days, they're all the same. There's no difference. Now, when we're declaring dividend, the dividend under the cost method, increasing your income, where in the equity method goes directly to your investment, decreasing your investment in this case. Make sense? Second difference on the reporting date. On the reporting date, that's going to affect your investment. In here, there's nothing. No records here. We're not recording anything. When the other company report income under the cost method, since we don't have significant influence, nothing. But when we have significant influence, that increase our investment. Make sense?
Yeah.
So now you can see which one is related to our investment and which one helps to our investment, which one doesn't. So the other thing that I want you to see is on which event triggers income. In the cost method, the dividend is the one that triggers income. where in the equity method, when the other company report net income, that increases our income. Let's highlight it in green so you can see it. Make sense?
Yeah.
That was the interesting thing with versus cost method versus the equity method. So now the question is, once we have this equity method, right? Is it possible? The next question will be, once I have this equity method here. Is it possible my balance instead of debit to become credit?
Mm.
What do you think?
Debit credit?
Yes.
Mm. Mm.
Let's think about it. What if this company, instead of net income, they're reporting net loss?
Mm.
What's going to happen if they report net loss 50,000? Well, I'm going to have a
Decrease.
debit investment loss
Uh-huh.
of 15,000, and credit is going to go to my investment.
Pigment.
Make sense?
Yeah.
So where is that going to hit me? That's going to hit me instead of here. I'm not going to get here anything, but I'm going to get here something.
Mm-hmm.
And that my investment is going to go here. So where's my balance now? Become credit.
Credit.
So instead of investment, now I have a debt.
Mm-hmm.
That's not the preferable scenario, isn't it?
No.
No. You're thinking that you have investment, suddenly no, you don't have investment. Now
Yeah.
you have to pay.
Supplement.
So that's what this slide here telling you. Impairment, what was that? Losses exceed the balance on the investment account. Now, if the investment, if in this case happened, when we move to the credit balance, now if the investment guarantee an investment obligation, the investor could end up reporting investment as a liability rather than asset. The other long-term investment is the associate may have to be write down the reporting losses. Associate is reporting losses. So every time when the associate reporting the losses, we have to write down. Now, impairment losses. If there's indicated that the investment might be impaired, we have to test it for the impairment.
Yeah. Mm-hmm.
And gain and losses of the sale investment, that will be the average cost. So basically, if we decide at this point to sell something, let's go back to Excel spreadsheet. Let's go now in Excel spreadsheet, and I'm going to get the first one, the very first one, which was right here. And let's move it here. In this scenario, we still have ending balance. Now, let's say we want to sell all of it, right? We're selling everything. Event 5 here, we're selling. Sold the asset, sold the investment. How much we selling it? Give me some price.
Oh,
How much the market is going to pay?
2,000?
No, per share.
Per share?
Yeah.
Maybe $8?
Fair market value. How much?
$8, maybe?
$3? $5?
$8.
$8. Okay, $8. Let's go with $8. Market pays $8. So
Mm-hmm.
now we have to find, do we have gain and losses, right?
Mm-hmm.
So in the first case, debit. what we're going to debit? We're going to debit cash, right? We're going to get cash. How much cash we're going to get? We're going to get how many shares we will get? We get 2,000 shares
1,000 shares.
times $8 per share. We get 16,000. But we have to close our investment, which investment sitting at 12,000. This plus this one, 12,000, and we're gonna have credit gain on sale of investment. Of 4,000, right? 4,000. Done. Now the next, in the other scenario, now we're gonna have cash 16, right?
Yeah.
But our investment here is way higher. Make sense? So now let's close that investment. Credit investment. And my investment here will be, the amount that I'm closing is this one plus this one minus that one. In this case, what I'm going to have?
Loss.
Loss. Do you see the difference? It doesn't mean that both are going to end up in the same scenario. Debit loss on sale. And that loss will be equal to this one minus that one, $4,950. So here we closing this investment at 12,123, boom, done. And here we closing this one with 20,950. And now I have to add this one in the formula minus that one, and we end up to 0. And that's how we closing this. So now if I sell only 1,000 here, let's say we're selling only 1,000 of the shares. We're not selling the 2,000 shares. The next scenario is instead of selling the whole investment, we're selling only partially of the investment. Let's say we fair market value, but we're selling only 1,000 shares. Or half of the investment. So what's going to happen? How much cash? We're going to cash. We're going to get 8,000 share. 8,000. Actually, 8,000, right? We're going to get 8,000 cash. Now we're going to close half of the investment. No, I better move to the new screen. So we can make this more practical. Where we are. This one is the one. So in this case, let's move to this screen. Here we go. So this one doesn't exist. This one exists now. We're not selling entire, we're selling only 1,000. We're gonna get 8,000 cash. Now the investment, we're not gonna close it the entire investment here. Right? We're gonna close half of it. Make sense?
Yep.
So that will be 10,425. So that will be equal to this one plus this one minus that one in the brackets divided by 2. $10,475. And then we're gonna have, I'm still gonna have loss, but only in the half of it. Make sense?
Just of the half?
Just on because I'm selling only 1,000.
Oh, yeah.
Right? And then I'm gonna have this amount here. So the half is going to stay. But since I'm selling half, now the portion that I'm owing is now become only 15%. So I lost my significant influence. Make sense? So now I have to move to the cost method.
Oh, okay.
Right? And next time now once I move this to the cost method, my average price per share will be 10,475 divided by 1,000. I'm going to see how much is my average price per share. And based on that, I have to start new calculations. That's the interesting part with this. So let's go back to our slides and finish those slides. Oh, that's not the one that I'm chasing. Which one of these? Second. It's the one that I'm chasing. Okay, for some reason, just give me a second here. Let me close some of the chapters because I have so many chapters open now here. It doesn't give me the proper. Here we go. So that's where we get the gain and losses on self-investment. Now, if you have the sell and loss when we're doing an equity method, the average cost should be used to determine any gain and loss, right? That's the way we did it. We're using the average. Okay, and the next one is held for sale. If the investment in the associate meet the criteria to be classified held for sale, should be measured the lower of carrying amount of the fair value. So why somebody wants to move long-term investment into the held for sale? This will be the question that you should ask yourself. And that will be only and only, probably you have discussed this one in 331 again, intermediate. That's where it's discussed this one when you're flipping the long-term asset into held for sale, and that's where you're going to the recognition of the held for sale because there are 6 criteria that has to be met in order asset to be moved from the long-term assets into the held for sale. But when you do that, you're actually improving your current ratio. So if you have problem with the current ratio, one of the tricks that you can use is to move the long-term assets or long-term investment in this case into held for sale. But again, you have to follow the standards, international financial reporting standards, and to that item, that particular asset has to meet all the 6 definition criteria to be transferred to held for sale. Presentation and disclosure, the fair value of the investment associated should be disclosed and when all the information is available. So the analysis of the financial statements. Again, the analysis here will be the impact on the key ratios. Now what's going to happen here? Fair value through profit and loss investment. Now we're talking about a non-significant influence. If you have fair value through profit and loss investment, they must be shown as a current assets, where the assets as the other comprehensive income is going to show as a long-term assets. Fair value to profit and loss investment show the best liquidity and profitability because they're current assets. So liquidity, you have adding more assets, and the profitability, since any dividend from those assets is directly declared to the net income, improve your profitability. On the difference between international financial reporting standards versus accounting standard for the private enterprises, those are the differences. Now, see which section they covering the international accounting standard for the private enterprises, 3051 and 3856. Now, do you need to know those sections by numbers? I would suggest yes. But since you don't have access to those standards, it will be very difficult for you to make some, how can I say, to make a relationship between the number of the standards and the standards itself.
Okay.
Right, but keep those slides in order. Save it somewhere, because at some point you want to know the differences between one versus the other. The last thing that I want to show you today is the difference of treating investments between fair value through profit and loss and fair value through other comprehensive income. So let's go back to that Excel spreadsheet, and very quickly I'm going to explain this, and we're done for today. That was the chapter. Chapter 2 is done. So we covered successfully both chapters. So now watch this. We already know the basic accounting equation, correct? We have assets, which is equal to,
Equity. Okay.
so that will be equal to
Liability.
liability plus equity
Okay.
here, right? Other comprehensive income is part of the retained earnings or part of the equity. Let's say part of the equity, which later is going to be close in the retained earnings. So here we're going to have as an element other comprehensive income. Now, the other thing that we need to understand is the retained earnings. Retained earnings is also close in the equity, correct? So here we also have the retained earnings. Now, from where the retained earnings comes from? Retained earnings comes from the net income, right? What affects the retained earnings? The retained earnings is affected, let me grab those one quickly. Here, if we have the dissection of the retained earning account and retained earning account, retained earnings here, obviously the balance here will be credit, right? Not debit. So increase comes from the net income. Decrease is coming from the dividend. Every time when the company declares dividend, that decreasing the retained earnings. And if we have net loss. And that's give you the balance. So now, option 1, fair value through profit and loss. If that's how we're treating our investment as a fair value through profit and loss, that means we're going to have sales, we're going to have cost of goods sold, then we're going to have gross margin, then we're going to have operating expenses, and then we're going to have loss or gain, let's say gain on unrealized gain. Make sense? Let's format this all together. So this is our first calculation here. Then we're going to have that second calculation here. And the last one is net income, which net income goes here. Correct? So let's pretend our sales are $100. Cost of goods sold 20. Gross margin is going to be this one minus this one. Which one is this? That's 20. Let's move all those to 20. Then we got other operating income, which is, let's say, 30, and then we only realize 10. So the net income here will be this one minus 30 minus 10. And then that net income is going to go here. Make sense? It's going to go 40. So my balance here will be equal to this one, it will be 0. Let's say that will be 0. It's going to be equal to this one plus that one. My ending balance is 40. Now, if I use for a second fair value through other comprehensive income, so when this comes here, 40 is going to come here, correct?
Mm-hmm.
40. And my equity is equal to 40.
Yep.
Let's copy this and move down. Now, the
Mm-hmm.
next situation is fair value through other comprehensive income. Now, unrealized gain is 0 here. Make sense?
Yep.
Now, I have gain. Actually, no, this is actually is not. This is unrealized gain that has to add to the income. So that's my calculation here is wrong. This one minus this one plus that one, right?
Oh, yeah. Yeah.
That will
Mm-hmm.
be 60. Then net income will be here 60. That's going to make my balance 60. My retained earnings is equal to 60. And my equity is equal to
6.
60. Right? Or it's going to be, my equity is going to be equal to other comprehensive income plus 60. That's how it should be. Now, in this case, let's move now to see profit and loss through fair value through other comprehensive income. So in this case, my unrealized gain is 0 because I'm showing my unrealized gain here, 10. Make sense?
No.
So if when I'm reporting
Mm-hmm.
unrealized gain to the other comprehensive income,
Mm-hmm.
that means goes directly here,
Ah, yeah.
right?
Mm-hmm.
I'm not touching my current net income. My
Mm-hmm.
current net income now is 50. Make sense?
Yeah.
But my equity in both sections, in both
Mm-hmm.
scenario is 60. Here I don't have other comprehensive income. Here I have it.
Ah, yeah, yeah. Mm-hmm.
Make sense?
Yeah, it makes sense.
That's the only difference.
Mm-hmm.
Now we can see the difference between fair value through profit and loss and fair value through other comprehensive income.
Okay.
I wanted you to see this. In the first case, your income is higher. That's why it says in the slides under fair value through profit and loss, your profitability is higher. Why? Because you have more income.
Mm-hmm.
Fair value through other comprehensive income, profitability is lower. Why? Because it goes directly to the other comprehensive income. It still go to the equity. Don't get me wrong here. Equity is not affected, but different presentation affects your net income.
Mm-hmm. Okay.
That's all.
Okay.
So I can post. I'm gonna post this one.
Yes. Yeah, please.
If you stay with me, you're gonna see it where it's posted. No, actually, I'm gonna send you email with this.
Okay.
I'm gonna send you email, and I'll tell you why I'm gonna send you email, because after that, teachers end up using my materials
Yeah.
and sending it to you and saying that they did it. But it's gonna be hard for them to explain it. So let me send you email with this,
Mm-hmm.
and you're gonna have it available.
Okay. Thank you.
Okay, so we covered those 2 chapters.
Yeah.
Means that next Saturday you are free.
Kind of free because we have to work on the
Yeah,
assignment.
but if you do both assignments this week, next week you'll be free,
Oh, yeah. Mm-hmm.
right? So don't forget, please don't forget this. And under the assignments, you have Excel spreadsheets.
Mm-hmm.
Don't forget to check those Excel spreadsheets, please.
Okay. Yeah, yeah.
Okay?
Okay.
And that will be all for me, guys.
Okay. Thank you so much.
Thank you
Thank you.
for
Thank you for
staying.
the
Now go enjoy your sunny day.
Okay. Thank you.
Run outside as much as you can. I
Mhm.
cannot run, I cannot walk, but you run, please.
Yeah. Okay.
Use your legs as much as you can. You won't believe how much I appreciate now having legs.
Yeah, I know.
Thank you, guys.
Thank
Thank
you.
you.
Thank you.
Bye.
Bye.